Great. Well, welcome, everyone. I'm David Weinstein. I'm the director of the Center on Japanese Economy and Business, also known as CJEB at Columbia Business School, and the Carlos Shoup Professor of the Japanese Economy at Columbia University. We're delighted to have you join us for today's lecture on why has Japan become so cheap? It's a topic that is very much of interest to me because I'm going to take a little vacation in Japan in December, partially because Japan is so cheap. But before turning it over to today's speaker, I will briefly introduce the center. As we have many new faces in the crowd. CJEB was established in 1986 by Hugh Patrick. And in 2019, I became the director. The mission of CJEB is to promote knowledge and understanding of Japan's economy and its business systems in an international context, basically bringing Japanese ideas to the United States and also transmitting US ideas to Japan. And we continue to grow via webinars, and that were an incredibly successful set of events. And we are delighted to be returning to in-person events at Columbia's new business school, or new business school buildings, on the Manhattanville campus. I'm really honored to introduce my good friend and colleague and today's speaker, Professor Takatoshi Ito, who is the director of the program on public pension and sovereign funds and the associate director of research at CJEB and a professor at the School of International and Public Affairs. As many of you know, Taka is a distinguished economist and scholar who has written on a wide range of academic and policy-relevant topics. He has taught extensively both in the United States and in Japan. He was a professor at the University of Minnesota, at Hitotsubashi University, the Graduate School of Public Policy at the University of Tokyo, and among other places. Taka was president of Japan's Economic Association in 2004 and has been a research associate at the National Bureau of Economic Research since 1985. He's been teaching about the Japanese economy and Asian financial markets since he came to Columbia. And those of you who are in my class know that his book is required reading for my lectures. It is an amazing book for understanding what is happening in the modern Japanese economy. Taka also has broad experience in government. He was appointed to the International Monetary Fund as the senior advisor in the research department and served as Japan's Ministry of Finance Deputy Vice Minister for International Affairs from 1999 to 2001. Notably, he was awarded Japan's National Medal with Purple Ribbon in June of 2011 for his outstanding academic achievements. This is our 8th annual lecture, or his 8th annual lecture on the Japanese economy, and it's become a cornerstone of our programming as he discusses Japan's economy and economic policies. One of the great things about Taka is he has a tremendous nose for identifying relevant and pressing issues. And today's lecture is no exception. And this is one of the reasons that his lectures have become so popular here at Columbia. Today he's going to discuss Japan's the Japanese yen's 24-year low against the US dollar, Japan's continuing low inflation rate, and his recommendations for the country's economic future. Taka and his work are invaluable to the center, and I'm really delighted that we've been able to continue to hold him here at Columbia. I also want to take a moment to thank our corporate and individual sponsors. listed in the booklet you received for their generous donations. We really couldn't do this type of programming without you, and we really appreciate everything you've done for the center. After Taka's presentation, we'll have some time for question and answer. So please think of some good questions to ask as you're listening to the talk. We also welcome everyone to join the reception following the talk. And before I turn it over to Taka, I just want to remind everyone to please take your phones out and check that they are silenced so that we don't have any interruptions during the talk. Please follow us on Twitter and LinkedIn to stay up to date on CJEB's activities and programming. So without any further ado, I want to turn the floor over to Taka.
Good evening, and thank you, David, for a generous introduction. And as has been advertised, my talk is why has Japan become so cheap? And I started with some examples, and many of you have experienced the very expensive ramen in New York compared to the Tokyo. So this is the same ramen, and price in Japan is at today's exchange rate $5.66. And in New York, I went last weekend, so this is a true price, that $23.20. Same ramen, right? And this is a famous example of Big Mac that the magazine called The Economist keep tracks of Big Mac. Same Big Mac. It's a trade secret, but it's patented that it's same Big Mac all over the world. And today it's $2.83 in Tokyo. Actually, the price was raised in last month from 390 yen to 410 yen. Very modest increase. And in New York, it's with tax, $6.09. This is a true price because I went to Big Mac last Monday. So the Amazon Prime, the monthly rate is 4.7 times in New York. Yeah, ramen 4 times, Big Mac double, and Amazon Prime almost 5 times. And this is Uniqlo Heattech Extra Warm crew neck tee, and it's 1.8 times. So it's rather close to Japan price in Fifth Avenue, New York. Okay, the last example is university tuition. And University of Tokyo and Columbia University, this is the published rate, and it's 17 times, before rooms and board. So just pure tuition, it's 17.7 times. And of course, David would say, you're not comparing apple and apple, like 4 examples before, the 4 slides before. This is, you're comparing apple to orange. And because the Columbia education is much better than University of Tokyo. But that's David's opinion. And, but this is a striking difference in the price. Okay, so with this introduction, yes, the prices in Japan looks extremely cheap. And why that is happening is today's lecture. So I'll give you the conclusion first, as I always do. And of course, Japan is cheap because the exchange rate is the yen depreciation made those conversion to be Japan becomes cheap. And but in the long run, it's more lower inflation in Japan for 30 years or more compared to the US that has been accumulated in price differential. So both exchange rate and two inflation rates, that determines which is cheaper and so on. So combining those exchange rate and inflation differential, we have the measure called real exchange rate. And I have been comparing Japan and the US, but I can compare Japan versus the rest of the world by taking the weighted average of those multiple exchange rates and multiple inflation differentials. That's called real effective exchange rate, which I will show you. And striking feature of real effective exchange rate is that this yen, Japan becoming cheaper has been going on for about 30 years. So it's not just this year's phenomena, Japan is cheap, but it has been accumulated for the last 30 years that Japan is now very cheap compared to United States. So the yen depreciation and inflation differential, those are the phenomena we see, the variables we see. But there must be a root cause for those economic variables to behave like that, okay? So that's, we are going into the analysis from the facts, data. And my take is that the root cause is the productivity differential. So Japan has been very slow in productivity advances or innovation that will make productivities to change. So, and especially so in tradable goods sector. So if the productivity is slow to increase, or in other words, lack of the technological progress, or in other words, the innovation is not happening, that the wage will not rise because companies do not have the resources to pay the wages because productivity is not rising. Basically, you can think productivity gains could be very equal to the real wage, and because companies can pay the higher wage if the workers are more productive, okay? So the stagnation in the technological change, stagnation in real wage, and the real effective exchange rate decline or depreciation. Those are the very much connected each other. Okay, that's what I would like to convince you what's happening. And this is especially, this produces especially difficult condition for Japanese young generations. And the old Japanese people can enjoy the next 20 years and retire, and that's maybe possible. But young people, they cannot do that. They will suffer for the next 30 years or so. So that's the root cause. If that's the root cause, as I argue, what is the policy prescriptions to change that? To change that the productivity will increase, the real wage will increase, and the Japan becomes expensive again. So basically, all the policies which are being talked about to raise productivity, how to raise productivity, how to make innovations in Japan, all those policy measures will be called for. And that's the fundamentals way to change Japan from today's very cheap condition to more normal conditions and hopefully maybe expensive country. Okay, so I will go into the details of those policy measures. Okay, so this is an outline how what you will learn in the next 45 minutes. Okay, so let's start with the fact-finding of the nominal yen-dollar exchange rate, which some of you have in your head. And some young people may find it interesting. But I start from 1990, which is the end of the Japanese bubble period. And how would you describe this yen movement? It's moving up and down, up and down, up and down. But if you take the trend, it looks like a trend going up until 2012 and sharply came down, Abenomics years. But there was an earlier peak in 1995, about close to 80 yen. But the yen appreciation peak, another peak in 2012, was around 75 yen per dollar. Those are the highest for the yen value. French wine, Bordeaux wine in Japan was very reasonable at the time, 2012. Now, the yen value is almost halved, right? You need twice as much yen to buy $1 this year, today. And that many people look at this and say, wow, it's an exchange rate, which is causing Japanese prices, retail prices in Japan to be cheap. So, cheap compared to the United States. That's half true. It's a half of the truth, okay? All right, so remember this nominal exchange rate movement. And so this is a yen, very fast, rapid yen depreciation this year, about 20% depreciation in several months. Another yen depreciation episode was 1998. So those are two episodes of very rapid yen depreciation. And what happened when that happens? Intervention. Try to stop the yen depreciation. So 1998 was the previous episode of yen buying, dollar selling intervention. So that has been, September 22nd, that the Japanese Ministry of Finance intervened. And headlines are that, it's so many years since last intervention of yen buying. There are other yen selling intervention in between. But the last yen buying intervention was 1988. Also, you remember that was a very rapid yen depreciation. Not only the level, but the speed is very important for the intervention decision. Okay, right. So in Abenomics years, 2013, 2014, everybody cheered. Yeah, finally, those yen appreciation is over. 75 yen. That was the hell. You cannot make exports profitable. And everybody's exporting industries are complaining, and many others also join the chorus that employment is lost and production reduced, employment is lost, and wage stagnate because yen appreciation. So yen depreciation was welcome. And that was one of the successes of the Abenomics, early years of Abenomics. So Abenomics and quantitative and qualitative easing, so-called QQE, introduced by Governor Kuroda, those were the engine of the reversing the hellish yen appreciation to more normal level and to the yen depreciation range. So at that time, it was like 120, 125 range and stabilized, if you remember the previous graph. So yen, in the shaded area Abenomics, correction of yen appreciation to yen depreciation area, but kind of stabilized around 110 for the second half of the Abenomics years. Okay, so that was good. That was welcomed. Now, yen depreciation of this year is not welcomed. This is kind of puzzling. Why yen depreciation of this year is not cheered by exporters and export industry-related industries. Okay, so one of the reasons why the yen depreciation is not so welcome this year is that they don't see that export volume to increase. So exporters could not or did not increase domestic productions to increase exports. Maybe they didn't have a capacity. Maybe they didn't think that it's a long-term phenomena that they have to adjust the production and exports. They just didn't increase the export volume. But of course, their foreign sales translate higher profit margin in terms of yen. So yes, you see many exporters reporting the record high profits. But that's not gained by the export boom in terms of export volume. It's just when they exchange foreign profits into Japan, the yen value is, yen amount is higher. So it's not felt like lots of activities generated by yen depreciation in Japan. So exporters have already shifted those production abroad, and now yen depreciation, and it's very hard to bring back those production capacity. So, hollowing out, which was the word most popular in 1980s and 90s, happened, and nobody talked about it anymore. But it was, it happened, and this is a consequence of the those hollowing out, that yen depreciation anymore no longer is welcome. And another thing is that Japanese inflation rate finally went up to 2% range, 2%, 3% range. And consumers are up and against, they're protesting that inflation is a problem. Okay, from New York, looking at Tokyo, 2% inflation is nothing, right? So we are suffering here at 8% inflation. Rents are going up 5%. In Japan, yes, 2% is, average 2% is generated by very high increase in gas prices, electricity prices, and some of the food prices. But no change in rents, no change in hotel bills. And so it's very skewed in Japan to energy and food, okay? And, but, gas and food are the prices that consumers face every day. So they complain for those price increases. And they identify, yes, gas prices going up because of yen depreciation. Well, it's half true or 1/3 true. and its global price is going up, that's much more the reason. And so those two forces, no benefits from yen depreciation. There's a lot of harm done by the yen depreciation, causing those gas prices going up, and the food and the fertilizer and all those imported goods are going up. Combined, complain and criticize Bank of Japan. Okay? So raise interest rate to defend the yen depreciation, would that be a right monetary policy? That's the question being debated, actually, in Japan. And Governor Kuroda's position is that, well, the 2% is achieved, but it will be, it's not sustainable because the energy and the food prices will be, well, at worst, plateaued. And plateaued and 1 year passed, then inflation rate goes down to 0. So those inflation rates of the gas and food will not be sustained until next year. That's a forecast. So unless the demand side will take over the supply side of the price inflation, then 2% will not be maintained. So we better be cautious of maintaining very loose monetary policy. And besides, that exchange rate is not in the mandate of the Bank of Japan and objective. And Bank of Japan law doesn't say exchange rate at all in the Article 2, or Article 1 and Article 2. So actually in Japan, unlike many central banks, other central banks, the exchange rate is, and intervention is not Bank of Japan's responsibility or the power. It is Minister of Finance. Okay? And it's kind of same in the United States. In the United States, it's half and half. They use money for the interventions. But in Japan, it's solely in Minister of Finance to intervene in the exchange rate market. So exchange rate policy is in Minister of Finance. Monetary policy is in Bank of Japan. So, if you're, Governor Kuroda didn't say it this way, but, if I read his mind, if you complain the exchange rate, talk to the Minister of Finance. They have the power. And they did. On September 22nd, the Minister of Finance intervened and spent about 20 billion US dollar. This is a disclosed amount, and buy yen, selling dollar and buy yen. By doing so, from 5 p.m. to 5:30 p.m. in Japan time, that yen moved from 145 to 140 by 5 yen. Then bounced back to around 142 and 43 range. And since then, kind of drifting to 145, but it has been sort of capped around 145. So Minister of Finance officials do not say it, but if I read their minds, this is a great success that we're going to stop the trend and reverse the trend, or at least capped that yen depreciation. And it has been almost more than 10 days, and that would be a good way to sort of stop the market trend. And Minister of Finance or any other G7 countries would not say that they have the target level of exchange rate. They say in practice that when they see the market disruption, some speculative move, then they could, and in this case did, intervene to stabilize the disruptive markets. That's the language they use and they practice them. So it's not defending 145. It looks that way, but it was a response to the very rapid depreciation in a week or so. And I did study all the Japanese interventions, past interventions. I have several papers on it. And the interventions are done when the level is deviated and a very fast movement, that deviation is accelerating. That's the point that they intervene. Okay, so that's intervention. And so stopping yen depreciation by using monetary policy is a mistake. And that's why the Bank of Japan is not changing the interest rate. Some people in Japan describe the situation as a great conflict between Bank of Japan and Ministry of Finance. Ministry of Finance tried to stop the yen depreciation. The BOJ allows the yen depreciation to continue by keeping the interest rate stable. That's probably wrong description of what's going on. It is more like policy instrument assignment that the domestic inflation target is given to Bank of Japan, and exchange rate management is given to the Ministry of Finance, and they acted on their ways, and that's not necessarily conflict each other, but this can be debated. Okay. All right, so this is, I already touched on. This is the exchange rate, the inflation rates, actually 3 kinds of inflation rates in Japan since 1993. Okay, so this is so it's been a long period of deflation, which is a negative inflation rate, from 1998 to 2012. Okay, so it's around 0 or even below 0. Only exception was 2007-8, which was, you recall, just before the Lehman Brothers crisis. And again, that was the time the energy prices are very high. Okay, and the energy price, the crude oil prices went up to 140 and so on, then crashed because of the global financial crisis. Except those several months, the Japanese inflation rates were negative or at most 0. And this deflation was causing a lot of structural problems. And again, people cheered Abenomics that, yes, the prices are brought back to the positive territory, and deflation is over, and companies can start investing again in Japan. So let's magnify the recent years. And this is a picture since 2010. I want you to, pay attention to the last several months this year. Okay, so it looks like finally we have achieved 2% inflation target. But blue is excluding fresh food and energy, so-called core inflation rate. And that is still below 2%. But including energy and food, you have close to 3%. Is this a time to tighten monetary policy? And as I said, probably not. And governor would say definitely not, because they are projected to go down, as energy prices and food prices will not continue rising at this year's pace. So in other words, the blue line, core inflation rate, is a more underlying trend. And it's just becoming 2% target, and not yet. So let's wait and see whether this trend will continue. Okay, so that's the inflation rate movement. Okay, so what happened between US inflation rate and Japanese inflation rate? I didn't show the US inflation rate, but it's around 2% consistently, okay? So cumulatively, this 2% American inflation, US inflation rate, and 0 or below inflation rate in Japan, cumulatively, what does it do, the inflation rate differential do? That is the cumulative difference in price level of the two countries, okay? So this is a level of the prices with the taking the 1995 January as 100 and keep track the price level of Japan and price level of the United States. Now, after all those years, there was a minor up and down you could talk about, but the end result is that US prices are twice as much as Japanese prices in price headline CPI price index. So this is, again, another reason, in addition to nominal exchange rate, that price differential is quite substantial cumulatively in all these years, okay? So if we are trying to understand the root cause of the Japan being cheap, that we have to keep track of this, both the price differential and inflation rate differential, and the nominal exchange rate. Okay, so going back to the exchange rate, the inflation rate a little bit, that, as I said, we finally achieved inflation target, and that should be a happy occasion for the Bank of Japan, Mr. Kuroda, governor, but it is not. People complaining, okay? So that's the irony of it. And one reason is, as I mentioned, that it is skewed, inflation is skewed towards food and energy, 20% increase and 30% increase, so which they see every day. And yeah, psychologically, it's very devastating to consumers. So they're not cheering for 2% inflation target achievement. And it is quite sudden change from long period of deflation and zero inflation. Probably consumers cannot catch up to this change. Third, that wages are not increasing. Income is not increasing very fast. So, they see this inflation as as a decline in their real income. So things would have been different if the wages are rising also at 2%. But for many workers, that's not happening, okay? And in the US, before COVID and before this 8% inflation, up to 2019, it is like 2% inflation rates, but wages are also, wages are also rising at 2% or more. So people were not complaining 2% inflation. In Japan, people are complaining 2% inflation because income is not rising. Maybe there are adjustments next spring when there was an annual revision of the wages, but it's too late. They cannot wait those 12 months to see that wages catch up to the inflation. They want now the wage increase. People are complaining and demanding the government to do something. And Prime Minister Kishida he said he would come up with the policy measures to fight inflation or to ease the pains of inflation next month. Actually this month. So we will see how the government will deal with this very high 2% inflation rate in Japan. So that situation's very different in Japan compared to the US. Okay, so no celebration, but achieving 2% is in sight. To make it sustainable, we need the measures to increase income so that consumption will rise when the energy prices and food prices coming down. Okay, so I already mentioned this, that BOJ is probably not to blame. That's only a phenomena, and also BOJ is adhering to 2% inflation target. So give them a break. Okay, so we need to dig deeper to why those yen depreciation is inflation rate, low inflation rate is happening, and my answer is that the productivity. Okay. To see that, before going into productivity, as I mentioned, as I advertised, that the very simple way to look at this cheap Japan phenomena is to look at a real effective exchange rate. And effective here means that we look at not only dollar-yen, but the multi-currencies that Euro-yen and Yuan-yen and British pound-yen, all those exchange rates of the trading partners, vis-a-vis trading partners. So that's what effective means, that's multi-currency concept. Real is you adjust for the inflation differential. So we combine those nominal exchange rate and the inflation rate differentials and make it multi-currency concept. That's real effective exchange rate. And this is a very good way to look at countries' goods are cheap or expensive. Okay, so this is a real effective exchange rates since 1964 for G7 countries and Switzerland. Okay, and you might say, well, wait a second. Before 1971, it was a fixed exchange rate regime. Yes, but fixed exchange rate, that's nominal exchange rate, and there were inflation differentials. Actually, Japanese inflation rate during the Bretton Woods system before 1971 was around 5%, vis-a-vis US 2%, 3%. So inflation rate was higher in Japan than the United States. And this is a real exchange rate appreciation. So the blue was increasing from in 1960s because of the Japanese inflation rate being higher than the trading partners. Then after 1971, nominal exchange rate appreciation from 360 to 300 to 250 to 200, that's the nominal exchange rate, taking the real exchange rate much higher. Okay, so when was the peak? Peak was 1995, spring, around April, May, and came down as a trend to today. So as a trend, Japanese real exchange rate went up from the 60s to 1995 and came down as a trend. And this is very striking shape compared to other G7 countries. that other G7 countries were kind of not changing much. And Switzerland is orange, which was going up slowly, up and up, up. And this year it kind of crossed with the Japanese yen. Below that was a green Germany, and that kept around the same real effective exchange rate from 60s. And other G7 currencies, it's kind of depreciated over the half century and more. Okay, so Japan looks very special in experiencing this very high appreciation, rapid trend appreciation to 95, and trend depreciation. And current level is like 1972. Okay, so we gained and lost in the exchange rate, real effective exchange rate value. Remember when I showed you first figure of nominal exchange rate bilateral US dollar vis-a-vis US dollar? The peak was 2012. Peak was 2012. Here, peak was 1995. Why? Well, Japanese prices are being very low, so that it kind of depreciated in real effective exchange rate. That cumulatively, that it has a very large component. Okay, so comparing Japanese nominal effective exchange rate and real exchange rate, the difference is the cumulative price inflation differential. So you see it's getting bigger and bigger. And those inflation rate differential cumulatively has very large effect contributing to the cheap Japan. So the difference, cumulative difference is in the green bars, and that shows what I've just said. Comparison to a Switzerland. This is another country which experienced very trend real effective exchange rate appreciation. And it's unlike Japan, Japan had up and down. Switzerland, it's all gradually going up, and finally it's crossing with the Japanese yen this year. But again, this is the difference is prices. You know, the Switzerland, in Switzerland, it's very expensive. Everything is very expensive if you visit Switzerland, and that shows in this difference between the nominal exchange rate and real effective exchange rate. Okay, so why the real effective exchange rate behaves that way, or movements can be explained. And international trade theory, international finance theory has one hypothesis. This is a hypothesis, which is called the Balassa-Samuelson effect. And this is a bit academic discussion, but the productivity gains in tradable sector and non-tradable sector. And tradable sector, which is like manufacturing, auto, and electronics, has larger productivity gains than services, which is typically non-tradables, like hotel service, hotel rates, and retail shops, and so on. Then the productivity gains are higher in tradable sector and lower in non-tradable sector. Then take this difference and compare that to the foreign countries. And if the differential is higher, then you tend to have the real effective exchange rate appreciation. There are several assumptions to this hypothesis. So, going to the hypothesis, you can debate about whether the assumptions are correct or not. But if you believe this, and also in the international trade textbook and international finance textbook, the Japan was taken as textbook so-called textbook example of this balance-Samuelson effect, and textbook written before 1995, that this was a good explanation for Japanese yen real effective exchange rate appreciation up until 1995. And you can dig up old international trade and international finance textbook, and it said so. Okay, so can we extend this hypothesis to today that what would be the explanation from balance-Samuelson hypothesis? It would say that the Japanese tradable sector productivity gains declined substantially. And compared to the Japanese non-tradable sectors, and that difference, shrinking of the difference is much faster than the United States and other countries. So that would be, if that can be found, then we can say, this is a reverse balance-Samuelson effect, and this would explain this real effective exchange rates going up and down. Okay, can we do that? Okay, so productivity is very difficult to measure actually in economics, and there are several ways of measuring it, whether that's the value added divided by the number of workers, value added divided by the hours of the workers, and what about the industry differential and so on. So there are many productivity measures, but most of the according to most measures, yes, Japanese productivity gains were slower in the United States since the mid-1990s, and especially, and the level difference is much higher in the service sectors. Japanese service sectors lack innovation. That's the sort of the conventional wisdom. And it's kind of difficult to assign which sectors are tradable and non-tradables, but we can usually use manufacturing as a tradable sector and services as a non-tradable sector. Okay, so this is, I didn't do it. Somebody wrote a paper comparing those productivities, and one is a US, that's the normalization. So you could see these lines go up and down, or down and down, is the difference from the United States. So United States having, let's say, 100 productivity, then Japanese service industry productivity is like half, or right now. The manufacturing productivity is, this is kind of an interesting movement. I didn't know that until I read this paper that went down from 75% range to 55% range, which is a substantial decline in manufacturing sector productivity compared to the United States, but regained some of the loss in the last 20 years. Okay, 10 years. So if this is true, then my sort of hypothesis of reverse balance-Samuelson doesn't work. But still, this, so I pose to you that what caused this real effective exchange rate is still unanswered questions. But productivities are actually a very important concept to think. And because productivity gains, as I mentioned, will be translated into wage increase, and wage increase will generate consumption, and consumption will generate the prices to rise. Okay, so lack of innovation, this is my hypothesis of the stagnation of Japan, and probably the source of the cheap Japan So there are several examples that we can point out as not so great success or actually failure of the Japanese innovation recently, that Japan could not develop COVID vaccine. They tried, but they couldn't come up with the vaccines. And Mitsubishi Heavy Industries tried to create the jetliner, 100-seater jetliners, and which would rival the Brazilian and Canadian Bombardier aircrafts, but couldn't make it complete. So they sort of abandoned the project. And Japanese universities are falling in the global ranking. And also, the disaster at the Fukushima Daiichi is a problem. And renewable energy in Japan is still struggling to gain the momentum. Okay, so these are the bad news, very bad news for Japan. And another more recent phenomena or lack thereof is the startups, that innovations are made by startups, right? So Google was a startup, Apple was a startup, and the Pfizer and Pfizer-BioNTech was a startup, and of course the Moderna was a startup in Boston. But we don't see all those globally successful startups in Japan. And people are wondering why that is so, okay? So, and we call them sometimes unicorn. The very big startups within 10 years are called unicorns. So somehow, Japan is not very good for unicorns to proliferate. Okay, so what should we do? What should Japanese government do? So one problem is that the so-called lifetime employment combined with the seniority wage system. Okay, why is so? Well, basically the seniority wage system and lifetime employment practice, it's not a law, it's a practice, binds the workers to a single firm and delay the payment, the wages, to later years of the workers in the same company. Okay, so imagine that productivity increase as blue line. But Japanese workers are paid less than productivity that they are creating when they are young, let's say 20s and 30s, and I see some of the Japanese young in the audience, and they're nodding, right? And Japanese old, let's say, the 40s and 50s, are receiving the wages and salaries above their productivity. And all the Japanese old people here just looking down. And so this is a way of the Japanese companies to keep the workers in the company, and trusting that they stay, they put the human capital investment, the skills, but skills only good for that company. And they are rewarded for staying long and learn those skills good for that company. And they'll be rewarded in the 40s and 50s, and I didn't show it, but there is a big jump at the last moment as severance pay. And that is actually quite big. So the system of the seniority wage and the lifetime employment is to keep workers in one company by not forcing them, but putting the incentives of this wage slope to stay. And workers did stay. Many of them did stay. But this is breaking down now because that Japanese companies do not live forever. Unfortunately, many companies failed in the last 30 years, and more so recently. So workers are not guaranteed for those deferred payments towards the second half of their workers' life. So they're quitting if they are not paid at fair wages, fair being a productivity contribution of them. So this system is actually breaking down, and the productivities gains are lost in that sense that unless the workers find good ways to invest into themselves. Retraining or reskilling, those are the words frequently heard. Okay, so and also it's good to have the prepay system of the retirement severance pay. That would be a great way to increase the mobility of the workers, and workers retrain themselves for the new kinds of jobs, new kinds of industries where the workers are demanded. Okay, so this lifetime seniority wage system is bad for labor mobility, responding to where the workers are needed, and make the productivity gains less. Okay, the another phenomena is that Japanese multinationals are expanding to the foreign countries for the factories and sales and so on. So many well-known Japanese companies like Toyota and Sony and Canon, their earnings, global earnings, more than half are from abroad. To Japanese workers, globalized. Well, I have some doubts about it. Of course, the excellent companies like Toyota, Sony, and Canon, yes, they are investing in the human capital to make it a global workforce, but they are probably more exception than the general trend. So they're not, companies are getting those global earnings, but the workers are not. So that's another problem. Okay, so policy prescriptions would be that we need to create innovation. We need to create innovation in Japan. And to make the innovations, there are several pieces to that. And one is that the university. And we need to make universities reformed so that they can respond to the need of the society, advances of the technology, and to produce human capital and innovation ecosystem to take place in Japan. So as you saw, as I showed you, the tuition is low, but also the professor salary is low. And PhD students pay tuition but receive no stipend, which is just reverse in Columbia University. So there is not emphasis on the research and producing the innovations from universities and around the universities. So we have to change. And to the good news, so there have been all bad news, but the one last good news is that Japanese government is creating this 10 trillion yen university fund. And this is equal to university endowment in the US universities, but it's done by the government. And the returns from the fund will be distributed to select Japanese universities. And this will start in April 2024. So a year and a half, we will see those fruits distributed to the university. Can this change this miserable state of the Japanese universities? That would be a question. And the answer will come in 5 years or 10 years. But this is probably last hope of creating innovation in Japan. So thank you very much, and we'll move to question and answers. Thank you.